Okay, so hello everyone. What we're going to learn today is about financialization in crisis. So a couple of years ago, hardly any economists knew about these terms, such as asset-backed securities, mortgage-backed securities, residential mortgage-backed securities, commercial mortgage-backed securities, asset-backed commercial paper, collateralized debt obligation, etc. So before the crisis occurs, these are the warning signs before it takes place. So on 2005, lenders took a greater risk to approving subprime mortgage loans to borrowers with poor credit, no asset, and at times no income. So these mortgages were repackaged by lenders into mortgage-backed securities and sold to investors who receive regular income payments just like a coupon payments from bonds. But consumer demand drove the housing bubble to all-time highs in summer of 2005, which ultimately collapsed the following summer. So first, the rise of subprime lending was fueled in large part seemingly inexhaustible Wall Street demand for these higher yielding assets for securitization, especially in a long-term low interest rate environment. These loans with their higher rates were in tremendous demand with investors, a demand that Wall Street was eager to meet. The private label securities market, or PLS Wall Street alternative to the government-backed secondary mortgage markets, grew significantly in the lead up to the crisis. The expansion of an unregulated PLS market and the development of the ever more complicated financial instruments tied to it are what transformed a housing bubble into the largest financial crisis since the Great Depression. PLS volumes increased from $148 billion in 1999 to $1.2 trillion by 2006, increasing the PLS market share to a total mortgage securitization from 18% to 56%. Next is the United States housing prices experienced a major market correction after the housing bubble that peaked in early 2006. Prices of real estate went adjusted downwards in late 2006, causing a loss of market liquidity and subprime defaults. The booming housing market halted abruptly in many parts of the United States in the late summer of 2005, and as of summer 2006, several markets faced the issues of ballooning inventories, falling prices, and sharply reduced sales volumes. Lastly, the credit crisis of 2007 started in the subprime mortgage market in the US. It has affected investors in North America, Europe, Australia, and Asia. It is feared that write-offs of losses on securities linked to US subprimes mortgage and by contagion, other segments of the credit markers could reach $1 trillion US dollars. It brought the asset-backed commercial paper market to a halt. Hedge funds have halted redemption or failed. CDOs have defaulted, and special investment vehicles have been liquidated. Banks have suffered liquidity problems with losses since the start of 2007 at lending banks and brokerage houses topping $300 billion as of June of 2008. So due to this crisis and depressions, there's a change of policy paradigm. So first, we have the second Keynesian pragmatic revolution. So this means that in contrast to previous financial crises, the IMF, or International Monetary Fund, advocates low interest rates and government stimulus packages with budget deficits. The G20 leaders also move away from unfettered markets and uncontrolled capitalism. So if you're wondering what is G20 is, it is an intergovernmental forum comprising 19 countries and the European Union. It works to address major issues related to the global economy, such as international financial stability, climate change mitigation, and sustainable development. Gordon Brown also stated that Washington consensus is out. So the Washington Consensus is a set of 10 economic policy prescriptions considered to constitute the standard reform package promoted for crisis-racked developing countries by Washington, D.C. Based institutions such as International Monetary Fund, World Bank, and United States Department of the Treasury. Also, Financial Times stated that the credit crunch has destroyed the faith in the free market ideology that has dominated Western economic thinking for generations. So there's two opposite views back in favor in the media. So first we have the neo-Austrian theory. So at the forefront of the second counter-revolution, the Austrian theory of capital concentrates on the inputs and outputs in the productive process and has an advantage over more modern theories of economic dynamics in that it is more naturally expressible in economic terms. The production process over time is taken as a whole rather than disintegrated. However, this approach had been largely abandoned because it seemed to be unable to deal with fixed capital. The book overcomes this problem here by allowing for a sequence of outputs, and the consequences for dynamic economics are profound and novel. Then next we have the post-Keynesian theory. So in the field of monetary theory, post-Keynesian economists were among the first to emphasize that money supply responds to the demand for back credit so that a central bank cannot control the quantity of money but only manage the interest rate by managing the quantity of monetary reserves. So in the Neo-Austria view, the U.S. government forced banks to grant subprime loans. The Fed set short-term rates at too low level from 2002 to 2004. The Chinese rigged the exchange rate and flooded long-term bond markets, also leading to overly low long-term rates. There would be no crisis if the government was small and interest rates were always set at their natural levels, or even better. If there was no central bank, the fiscal stimulus will make things worse. So that is the Neo-Austria view. While this is the view of the post-Keynesian on crisis, Western economies have moved towards a financialization process over the last decades with deregulation of the regulated financial system and growth of the unregulated financial system. The current regime of accumulation based on low real wages and consumer debt was unsustainable. Financial crises are an indigenous feature of unregulated capitalism, and as a result, financial crises are ever more frequent and more severe. So we have here four types of capitalism. First is finance capitalism. So finance capitalism or financial capitalism is the subordination of process of production to the accumulation of money profits in a financial system. It is a stage of capitalism in which economic and political domination is exercised by financial institutions or financiers rather than by industrial capitalists. Next is stock market capitalism. It is an economic system in which private individuals or business own capital goods. The production of goods and the services is based on supply and demand in the general market, known as market economy, rather than through central planning, known as a planned economy or command economy. Following is the money manager capitalism. As Minsky said, stability is destabilizing. The relative stability of the economy in early post-war period encouraged this transformation of the economy. Today's crisis is rooted in what he called money manager capitalism. The current stage of capitalism dominated by highly leveraged funds seeking maximum returns in an environment that systematically underprices risk. With little regulation or supervision of financial institutions, money managers have concocted increasingly historic instruments that quickly spread around the world. And lastly, the renter capitalism, which refers to the increasingly used to describe economies dominated by renters, rents, and rent-generating assets. It is also the belief in economic practices of monopolization of access to any kind of property and gaining significant amounts of profit without contribution to society. Then we have the financialization. So what is financialization? So according to Epstein, financialization is the increasing role of the financial motives, financial markets, financial actors, and financial institutions in the operation of domestic and international economies. So literally, it all talks about the money and finance. Then, financial institution following facts. So the importance of financial, insurance, and real estate sector has doubled, such as GDP share, profits relative to those of non-financial corporations, profit of banks as percentage of their total assets, and compensation of employees in the financial sector as a percentage of total compensation. While for the non-financial corporations, non-financial corporations now hold as many financial assets as they hold tangible assets. Hence, the interest and dividend income of non-financial corporations as a percentage of their gross value added has tripled. Also, non-financial corporations used to issue new equity to finance their investments, now often buy back their share instead. They also raise a larger proportion of their funds through bond issues. The interest payments of non-financial corporations as a percentage of their gross value added have quadrupled, and dividend payout ratio. So it was clearly shown as a percentage of their cash flow. Next we have is the distribution issues facts. So first is the wage share income has gone down. Then the share of income going to the renters has risen. Labor hourly earnings or even hourly total compensation of production in non-supervisory workers. The income share of lowest quintile has fallen. Then the income share of the highest quintile has risen, and there has been an incredible rise in the income share of the top centile. Following is the flow of funds facts. So the net accumulation of financial assets of corporations is positive, while the net accumulation of financial assets of household is negative. Lastly, flow of funds has been made possible in particular by the use of margin debt. Then we have the specification of financialization, securitization, and credit default swap. So when we say securitization, it means the procedure wherein an issuer designs a marketable financial instrument by merging or pooling various financial assets into one group. In theory, any financial assets can be securitized, that is, turned into a tradable, fungible item of monetary value, and in essence, this is what we all securities are. So these are the advantages of securitization. It reduces risk in banking system. It makes the payment system immune to insolvency. It also spreads risk to those best able to handle it. It is a stabilizing factor. It diversifies the supply of assets, and it reduces the cost mortgage. But securitization has its dangers. So one of them is that it disconnects the risk of the defaulting borrower from the bank granting the loan. It also creates a chain of self-serving agents getting bonuses. With the realization, there are more fraud incentives, lender-inducer liar loans. So for Minsky, this is what securitization is. So securitization helps financial globalization. Securitization will lead to credit-enhancing mathematical techniques. And for him, there will be a thin market if price and quality of the securities deteriorate. And lastly, it implies that there is no limit in creating credits, for there is no recourse to bank capital. Next in the slides is the financial markets blew up. on their own. So in the Minsky crisis, the problem starts with over-indebtedness of non-financial firms and explodes because of rising interest rates. So problem arose from indebtedness of household, and as in Japan, a meltdown of the real estate market and then the equity of market. So moving on to the conclusion, so the real estate market crashed before these negative effects could really take effect. But now two negative effects operating at once consumption. These are the long-run negative effects of higher flow of household borrowing relative income and the short-term negative effects of high saving rates directly from higher propensities to save and indirectly from a lower propensity to take new debt. So that's it. Thank you for listening.